Welcome to another VC Wisdom podcast. We have Matt Bodnar with us. We're going to talk about his company today, Erdalan Capital. We're going to talk about the deals that he's been doing, the kind of companies he's investing into, and his startup investment thesis nowadays. This podcast is brought to you by podpar.com. If you want to start or scale your own podcast, go to podpar.com. Matt, welcome to the pod. Tell me a bit more about yourself and what you're up to nowadays.
Awesome. Charles, thank you so much for having me on here. I'm excited to be here and dig in. This is a topic I'm really interested in. So I'll give you a 10-second bio on me from Nashville, Tennessee, which is where I currently reside. But I worked at Goldman Sachs up in New York for a number of years out of college. Came back to Nashville in 2011 and kind of accidentally sort of stumbled into buying an IT services business that I ran for about 6 years. We did a couple acquisitions in that company. Eventually fired myself as CEO and it became basically a full-time private equity investor. And my focus now really is around buying kind of to some extent the opposite of what you guys talk a lot about on this show, which is instead of sexy startups, like I'm looking for the old blue collar baby boomer, guy who's selling his plumbing company or whatever, and buying those like old economy businesses that are super under optimized, buy them for really low multiples and put in place kind of some modern systems and processes to help them scale. So our current portfolio, we still have that IT business. I've got a manufacturing company, an industrial distribution business, a staffing company, a software business, kind of a beauty products brand, a couple other miscellaneous investments. But that's our thesis. It's like old school value investing, is still alive.
And what are proven strategies to optimize these businesses? Because it may look easy on paper, but I mean, these businesses have established trust. They have some form of SEO, crappy websites most of the time, but customers keep on going back again and again. So how do you actually optimize these businesses?
Great question. Yeah, I mean, it's funny. You hit on some of this, like what end of 2022, actually like spring of 2022, we bought a business that was doing $10 million in revenue that didn't have a website, right? So like no sales, no marketing, no website, different deal. So that's just one example. Sorry, my computer was lagging a little bit there. That's one example, right? Different deal, different company. We bought a business that was 51 years old when we bought it, right? It was kind of a distribution company. And when I walked in, like the entire company was like an old folks home, right? Like everybody there was like 65, about to retire. The entire company operated on carbon copy paper. I don't even, you might even be too young to know what that is, Charles, but like the old carbon copy sheets that you would fill out, nothing was digitized. Their website was horrific. Their entire marketing budget was an ad, a TV commercial from the 70s, a TV commercial from the early 90s that they were still airing every week that didn't even feature any products that the business sold any longer, right? So the bar for improving some of these businesses is super low. You don't necessarily have to be a genius to say, hey, like maybe we shouldn't be using this TV commercial from the 90s, right? Let's repurpose that into things like paid media and modern kind of marketing budget. Let's take the operations of the company and put in place a piece of software and start digitizing our operations. And so there's a lot of times it's pretty basic stuff. But if somebody's making, couple $100,000 a year or even more than that, and they've owned their own business for 25 years and they're, 60, they have no incentive to grow. They have no incentive to reinvest in all of that stuff and they don't want to deal with it. Right. So that's why these market conditions exist in a lot of cases. Another third deal, I'll give you an example. We bought this business. It's another distribution company. The day we bought it, they were a little more savvy. So they were spending about $500 a month on paid media, right? Google ads and that kind of stuff. I like argued with the president of the company. I was like, dude, we got to, like, I want you to test. Let's double it. Let's get crazy, right? We're going to spend $1,000 a month. So he was like, I don't know, man, like taking some big risks, right? So we did it. It worked. That was like 2 years ago. Fast forward to, I think last month we spent like $25,000 on Google ads, right? So it's like, it's not, you don't have to be a genius to figure that out. It's like, well, let's keep spending on some stuff, basic marketing strategies that are working. The hard part is really just finding these companies that are unoptimized and that you can buy at really attractive prices and deal structures.
Right. And back then was, yeah, basic digitalization, maybe some automation. Nowadays with AI, what systems are you putting in that are incredibly good at adding value to a business?
Yeah, I mean it's changing daily, right? So we have kind of a playbook that we've developed internally when we look at a business, that we say, hey, like what can we look at automation, right? So we look at automation, we look at AI, we look at VAs and outsourcing, right? We have a resource, one of our manufacturing businesses, we just went through this whole like audit where we looked at like all the functions of the business and had this group that basically sources really talented people from overseas evaluate all the different roles, and we ended up like bringing in a couple people from the Philippines, to help with like augment. We didn't replace anybody in the organization, but we basically said, hey, we can augment what we're doing and get the existing team to scale, twice their level of effectiveness by adding in a couple folks from the Philippines. So we look at really all of those things. It varies. Like some of these businesses, at least today, there's not a huge use case yet for AI. Sure, like on the marketing front and stuff like that, there's massive use cases, and we've used AI for things like content generation and SEO and some other basic use cases. But there hasn't been any like thing where we implemented AI and we cut our X time by 50% or we reduced this thing by 50%. The closest is we're really, and if you have any recommendations about this, honestly, I'd be super interested. But we haven't really cracked the nut on this yet. But we're super interested in like help desk and support and how we can leverage AI to do that more effectively. So I have a gentleman that works for Eidolon, that's basically our director of portfolio ops, who kind of helps us implement strategic initiatives and that kind of stuff in the portfolio businesses. And one of our big projects we're looking at right now is how do we, we're basically evaluating all these resources. So how can we make a help desk more automated, more efficient, use AI to solve tickets and resolve issues so that it cuts down on the amount of human, drag time or whatever needed to execute that stuff. So no silver bullets yet on that front, but certainly open minded if we can find any good ones.
Yeah, I'll search a software for that because technology should be here. I definitely know what I don't want from a customer service standpoint. I'm a user of various softwares that have these AIs responding to me, and they're always pretty bad.
Yep.
Think, yeah, well, I always want to speak to a human in that case, but pretty sure they could crack it easily. You just have to feed it your database and your deeper database, I guess, so that the AI can learn from what has been resolved and what has not been resolved. Pretty sure there's a couple of company doing that. Yeah, I haven't cracked that on my side. I've definitely cracked the sales code with like lead gen, Apollo, Clay, and SendGrid, all these tools.
Yep.
Um,
Yeah, I love
but
automation on outreach is like that's really dialed in, at
nice.
least
What
in
do you
the stuff
use?
I've
What,
I've
what
played
are
with.
your systems?
I mean, we looked at a lot of stuff. I mean, we play around with a lot of stuff. Honestly, I don't even really know how AI augmented it is, but like LM List is one of my favorites for outreach. Just like plain simple, easy, plug and play. Cold outbound automation. It's not really AI, but Seamless.AI is one of the big ones we use for sort of lead gen. And then we kind of augment, like one of the roles we hired for is like we hired basically a full time kind of lead gen person in the Philippines to be kind of combining all these resources to generate the output of like an entire team of people, for one person's salary, leveraging a lot of these AI tools.
Hmm. Very cool. Yeah, though you most of your businesses they target B2C folks, right? So it's mostly consumers, or do you also run B2Bs?
No, we're kind of we probably actually skew more B2B. I mean, some of our manufacturer, like we have a business that makes portable sinks. It's like super random, but most of our sales are other businesses that want it, especially for health code compliance. That's a big driver. Though there's some other drivers of it as well. But there are like we're starting to penetrate consumer, so we think that's an area where we can like we're working on trying to get distributed in like Home Depot and some other places and stuff. But for somebody who wants like a high end portable sink and put it in their garage or take it camping with them or something like that, right? So um we're getting into consumer, but a lot of our stuff is B2B, like industrial distribution, those kinds of things. We're selling to other businesses and using tools like Seamless and Lemlist, et cetera, to target people and hit them with some outbound.
Give me your criteria list to absorb one business. Like, how do you distinguish between a product market fit and a non-product market fit? Do you also measure the opportunity over time? How do you calculate, like, if this business gonna grow over the next 10 years? How do you do the competitive analysis? Like, give me your full list of startup criteria.
Yeah, good question. And if you don't mind, I'll even go into a little bit of math that can kind of help explain this. And I'll tell you about my evaluation process too. But zooming out like 1 degree, to me, it's actually really interesting. I know you exist in the startup world in this podcast to some extent, is focused on a lot of startup stuff. To me, I actually think it's much more compelling to buy a business versus doing a startup, right? So if we look at the two kind of use cases, let's just say you can certainly start a startup without raising any money, right? And candidly, you can buy a business without putting any money in too, with the right deal structures. But generally speaking, a startup, you're going to raise a little bit of seed capital, right? So if we said, hey, we're going to raise a 300K seed round for a startup, right? What are the kind of end outputs of doing that? Let's say we do that. What do we have 18, 24 months later, right? We spent $300,000. We have maybe a couple employees, maybe an MVP, right? Maybe we don't even have the product built yet, maybe a couple customers, right? Or maybe we don't have any customers yet. We have still probably some open questions about product market fit. And in a best case scenario, we're probably raising additional capital, further diluting the founders and owners of the business to keep the train rolling into the future, right? So that's kind of, and you've heard the stats, I'm sure, but like the 2023 like small business stats or whatever just came back, right? Startups have like north of a 90% failure rate. So it's obviously high risk. Everybody knows that going into it. But versus if you take that same $300,000 investment, right, and you bought a business instead of doing a startup. Let's say you go buy like a local plumbing company or a local HVAC business, right, or whatever. Could be anything. Could be a veterinary clinic. Doesn't matter. You buy a business instead of doing a startup. In the U.S. at least, that same 300K, you can get what we have a program called the SBA, which will finance up to 90% of an acquisition price, up to $5 million. So if you put up 300K, right? So you raise it from friends and family, whatever. That gets you $2.7 million, which is the other 90% to buy a $3 million business. So what can you buy for 3 million bucks? On average, you could buy probably a business that's doing $750,000 or so of what I would call EBITDA or net income profit, however, cash flow, whatever word you want to use, right? So 750 times a 4x multiple, which is about the midpoint multiple for a company of that size, would be a $3 million purchase price. So you can buy a business with 750K of cash flow already. So what does that imply, right? So depending on what margin you use, let's say the business is doing around maybe a 15, 20% margin, it's probably going to be doing $4 million, north of $4 million of revenue, right? So if you're doing 4 million of revenue, you probably have, what's your payroll going to be on that? A million, 2 million, right? So you might have 20, 30, 40, 50 employees, right? You got 4 million of revenue, depending on what your average kind of customer value is. That's easily dozens of customers, if not hundreds of customers, right? So you got hundreds of customers, let's say 20, 30 employees. You're making 750 grand a year. You don't really have questions about product market fit because the business already exists. And in a lot of cases, I mean, I gave you an example earlier. We bought a business that was 51 years old, right? So it's been around for a while. That's the exception. But like most businesses have been around 5, 10, 15 years or whatever, especially if the owners are retiring baby boomer. So all of that stuff, right? Way, in my opinion, way less risky than doing a startup. And the crazy thing is, if you have that 750K of cash flow and you take out that $2.7 million loan, depending a little bit on what assumptions you use, but the debt service or the loan payments on that loan would be around $450,000 at prevailing interest rates. And so you basically would make 750, pay about 450 to the bank, and you have 300 left over, which happens to be the amount of equity that you put in year one. So it's basically 100% return on equity, right? Year one, in a way that's, in my opinion, substantially de-risked versus starting a business with no customers, no revenue, no product, whatever else, right? So in my opinion, I actually, like, again, I might be crazy, but I think buying businesses is less risky and has a much better kind of economic profile than doing startups. And that's to some extent how I think about evaluating that opportunity set. I don't know if that fully answers the question or not, but that's kind of my rant about startups versus acquisitions.
Right. Sort of answers the question. I mean, you look at the revenue as a source of truth, but you also evaluate the market and the current demands. Do you just check their revenue and see if it's growing year per year? Do you check in their CRM, their current customer base? What kind of due diligence do you do?
I mean, tons, right? And I mean, part of the diligence you're doing, you're screening on the front end, right? So I'm looking, you like most folks will have what's called a buy box, which is basically like, what am I looking for, generally speaking? And to me, I mean, revenue is a component of it, but I'm really targeting a level of profitability, right? So I want to buy businesses with, let's say, at least $2 million of earnings or EBITDA. And sort of the sweet spot that I target is kind of between 2 and 5 million of EBITDA. And so in that sweet spot, to be doing 2 million bucks of earnings, like, you know, back of a napkin, I mean, unless your margins are insane, right? You're probably doing at least $5 million on the low end, probably closer to 10 or $15 million of revenue, depending on your cost of goods and all that kind of stuff, right? So a business that's doing $2 million of earnings is going to have, generally speaking, some level of stability, and it's been around for a little while. What you want to look for though is like, one of the things I care about is like, what's the historical trend, right? So it's very common to ask for the last 3 years of financial statements to basically say, hey, and sometimes going further back than that as well. But like, what I want to see is, if I'm saying, hey, I'm buying this business off a multiple of the fact that it's doing $2 million of EBITDA, I don't want to look back in the year before it did 500K of EBITDA and the year before it lost money, right? To me, that's red flag. I'm out, right? If it did like 1.8 the year before and 1.9 last year and 2 this year, I feel way better about it. If it did 2 the last 3 years, I feel even better about that, right? And so I want to see a pattern of historical profitability around the same level of EBITDA that I'm giving them credit for on, whatever we're using for kind of the purchase earnings. That's one big risk factor that I pay attention to. Another thing that will immediately disqualify a deal for me is if it doesn't have management, right? If it doesn't have kind of organizational structure or complexity, if the whole business is dependent on the founder, the owner, I'll hit the eject button. It's just not going to work out, right? It's you're basically buying a job, and at that point, buying a job, those businesses do trade for much lower prices in most cases, right? Because in a lot of cases, you can't even give that business away, like just no one will take it, right? But in the event where they do transact, it's still a pain in the butt, right? I don't want to buy a business where the owner they work 70 hours a week, because then I'm going to have to figure that out. I want to buy a business that has a president or a chief operating officer or somebody who runs the company on a day-to-day basis, talks to the customers, has some sort of infrastructure. And generally bigger businesses, the bigger you go, like if you have a business that's making 100K a year in profit, there's a good chance it's run by the founder, right? If you have a business that's making $2 million a year of profit, even if the founder is integrally involved in the operations, like I can peel out, 150, 200 grand, 250, whatever, and hire a president to run that company because there's $2 million a year of cash flow to play with. So I like businesses that have management depth in place, right? So history of profitability is important. Management depth's really good. And then, I mean, I want to understand I mean, I could literally talk for an hour about like acquisition criteria, but generally you want to see, like, I prefer businesses that there's some level of predictability about the business and its demand cycle, right? So if you like, the opposite of that would be a construction company, right? Or something where the revenues are highly project dependent. I don't want to buy a business where even if it did 10 million in revenue this year, there's a recession and suddenly it's doing nothing next year, right? I want to buy a business where it's like, okay, I can see the demographic trends here. I can see there's a needed demand for this service. Even if and preferably it's something super boring. You know what I mean? It's like, okay, I have a business that sells shelving, like industrial warehouse pallet rack and shelving, right? But it's like, people like warehouse industrial growth is exploding. Like people are building warehouses all over the place, right? And so it's like all those warehouses need shelves, and we're going to try and sell them their shelves, right? So super boring, but it's a needed product. So I could talk more about it, Charles, but that's high level how I think to some extent about acquisition criteria.
Your deal flow, how do you get it? Like me, an outreach guy, I'd start from Apollo. I'd put like revenue, I'd put keyword, I'd put growth. Although growth is hard because it tracks off LinkedIn, and some of these folks, these boring businesses, they're not even on LinkedIn. So how do you start your search and how do you refine it?
Yeah. So short answer is yes. And by that, I mean, I do anything possible to source deal flow, right? I mean, I've run the spectrum. So I do a lot of cold email, right? We talked a little bit about that. I've done direct mail. Like I bought a business that was doing about $4 million of revenue with a direct mail campaign. Literally sent them, I mean, some people get, letters that's like, hey, I want to buy your house. I just sent them a letter that was like, hey, I want to buy your business. Right. So direct mail still works. I closed on that deal in 2022 to give you a sense. So cold email, direct mail, network is great, right? Obviously, you can't necessarily control inbound from your network, but some of the best deals will be sort of warm referrals from people in your relationship or relationships you have with folks. I still look at broker deals and marketplaces and stuff like that. Certainly, I prefer off market deals because you have more latitude, less competition, et cetera. But generally, I'm happy to look at brokered opportunities, and there's certain nuances you can use when you're talking to business brokers that you can find better deals. An example would be asking them for listings that they've had for a long time that haven't traded, right? And so that could be indicative of like a deal where the seller might be more motivated to transact and the broker might be more motivated to transact as well because they know that they're going to lose the listing if they don't get something done, right? So I short answer is I work everything, but probably the backbone of it is sort of anchored by cold email, which I'm still a huge fan of, even though it has gotten more crowded in the private equity world as a whole. If you know how to position yourself and craft your messaging, it can still be really effective.
Then at what point do you start investing heavy time, for example, and like, yeah, I would guess 10, 20 hours at most per deal, or maybe a bit more. Maybe I'm biased here. But yeah, when does that happen? How do you make sure that you don't invest a lot of time in a deal that's not going to happen? And then additionally to that amount of time, can you tell us generally how much days does it take for a deal to close?
I'll give you the market norm. I'll answer those questions in reverse. I'll give you the market norm. Market norm is it's about 45 to 90 days roughly for a deal to close from LOI to close, right? With 60 probably being the midpoint, 60 days. But every deal is different. I literally closed the deal. The craziest, the longest closing period I've ever had is I put a deal under contract. And granted, you'll understand in a second. There were some external factors that impacted this, but I put a deal under LOI in like March 1st of 2020 and I closed on the purchase of that business in March of 2022. Right. So literally 2 years and COVID hit and the business got disrupted by COVID and there was all these other factors and all this stuff going on. And I just like hung in there and kept, talking to the owners and say, hey, like I really like this business, but we got to figure some of this stuff out. And this is, challenging. And how are we going to navigate this and all of these different things? Just hung in there and eventually bought the business. Right. So it took me 2 years to navigate some of those market dynamics, but we got there. Right. Versus probably the fastest deal I've closed is probably in like, 45 or 60 days. But generally speaking, I mean, it's a much deeper conversation around like how to think about diligence and investing time and all these things. What I'll do is I try to get a rough sense of things, right? You want to look at the financials, understand economically, hey, are they in our buy box, right? Are they sort of checking all the high level boxes? And then we'll talk about offer structure. So it's like, hey, here's how we think about doing the deal. Here's how we would position the offer and structure it. And is that interesting for the seller or not, right? And if there's a misalignment there, then that's usually an easy way to just to take as an off ramp, right? It's like, hey, they want 7 times EBITDA for the business, and we think it's worth 4. We're not going to waste a lot more time. But assuming there is alignment there, then that's when you kind of sign a letter of intent or an LOI and start going deeper into diligence. And I mean, diligence can be pretty comprehensive, and oftentimes we'll use third parties as well to come in and do some assessment and analysis of their financials and maybe other elements of the business, depending on what we want to kind of unpack or de-risk. But there's you can also de-risk a deal in a lot of ways with deal structure, right? So and purchase price, right? So if I'm buying a business at a lower valuation and that business has a lot of hard assets or a lot of collateral or something like that, or I'm structuring it where I'm not putting a huge amount of cash up front when I purchase the business, it's not to say that you don't want to do diligence, but those things can mitigate some of the risk, right? And you still want to do due diligence on those deals. But if you're doing a deal where you're not putting a lot of cash up front and the investment you are making is secured by hard assets, where even if the business fails, you could liquidate the company and recover your investment, it's easier to feel good about the downside profile. And a lot of times, the more deals I've done, it's actually less a question. Like it's always a question of financial risk. I don't want to say it's not a question of that, but it becomes more a question of opportunity cost to basically say, hey, is this deal worth the time and energy? Like, and really a big governor of that is size. And that's why the more deals I've done, the longer I've been in the kind of investing world, I've just ratcheted up the size of deal that I'm willing to do. And I want them to do bigger and bigger, because the bigger the deal, the more money you make, right? For the same amount of time invested.
Right. So what's your budget nowadays on a yearly basis? How much do you have to invest in acquiring new companies? And also what's your success rate? Like, do you track that?
So yeah, I've got like an Instagram post somewhere where I went through all this math, but basically not in the last year I haven't done it, but for a year I tracked all of my stats on my deal funnel, and it was like I think I looked at 500 deals. I did a deep dive on about 100 of them, which is like talking to the seller, like putting some thoughts together. I presented I think 19 letters of intent, and we closed on 2 deals. Right, so you can reverse engineer whatever the stats are on that, but I mean it's a lot, right? You got to overturn a lot of rocks, especially if you're really looking for unique kind of value oriented opportunities. You have to be flexible. You have to be willing to really, kind of pry open things and turn everything over and find those little hidden gems. They do exist. You just got to look at a lot of deals to find them.
Wonderful, dude. Well, thanks for the value today. We're already out of time, but gonna re-invite you to the yearly edition. Hopefully, where can people find out more about you?
Awesome. Yeah. If you want to learn more about M&A and what I do and buying businesses, I've got a newsletter. It's free to join, mattbodnar.com. You can check it out and join it. And I talk a ton about finding deals, buying deals, financing deals, all kinds of stuff.